Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark takes a look at the markets over the past week. Author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, wonders if the home buying regulations the Trudeau government is bringing in to prevent a real estate-caused recession will actually trigger that recession. Ed Steer from edsteergoldandsilver.com believes the prices of those precious metals would be much higher if they weren't so manipulated by just a handful of big banks. Is there anything a small investor can do to deal with that? Plus, at the end of the show, we'll have company showcase updates with Larry Reaugh, the CEO of American Manganese, Aben Resources' Jim Pettit, Blind Creek's Brian Fowler, and Glance Pay's Penny Green. We'll talk to Ross Clark right after this.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to the show, Ross.
It's always a pleasure, Jim.
Gold it went to a nice high not too long ago. What's it doing now?
Well, it had a nice high. It's had a consistent sell-off just week after week here, and we're finally getting down to see some mild oversold readings. It's starting to become a little interesting here, maybe for a little bit of a pop. But, we've been looking at the gold-silver ratio, and silver, since that $50 high back in, April of 2011, it's consistently been just eroding against the gold. It's had maybe two short-lived pops. 2012 had a little pop, and then again into the summer of last year when gold also had that nice run. And we've been watching this, the ratio itself, and at the rate that silver has been dropping relative to gold, if we were to continue at this pace for another 1 or 2 months, we're going to get into a very interesting configuration where it will become oversold enough that we can start to look for a really good move on the upside. So, and this, we're looking at 5 decades worth of data. The way the indicators sit right now, weakness in the near term as we come into maybe the end of the seasonal period where you would look for, 2 normal seasonal lows in the gold just after December and just after June. So as we're moving through the month of October into November, we're going to start to watch for an important low in gold or silver, and in particular, if that ratio with silver against gold gets down into oversold territory, be looking for a pretty nice run. So right now that's on the horizon. Put together a report this week that outlines some of the background on that. People are more than willing to send in for it. We'll get that out to them in the next week or two.
And where should they try to get it?
They could send it to chartworks@gmail.com.
And Ross, can you give us just a little teaser about what's going to be in that report?
We've got some nice graphics going back showing you exactly how. Actually, I think we've got 15 times that this ratio has got into an attractive level, and of the 15, only one of them didn't produce advances of 25% or more in silver. So I think that should be enough of an incentive for people to take a look at it.
Now, when silver starts to move, it usually goes a lot faster than gold does, doesn't it?
Well, yeah. Now, the early stages of it, you generally get that spurt, very short-lived. Then silver will normally perform with gold, and at the tail end of the move, then you start to look once again for that big outperformance. And if you think back to 2011 when we put in the top I think silver went from $40 to $50 in this span of maybe a week and a half or so. And it's those type of climatic moves at the end when there's that absolute urgency on the part of speculators to want to be in, to not miss out on the next big play, the run to 100 that never happens. It's when we start to see that type of action at the tail end of a run that you've been looking to go to the sidelines. In the beginning of the move, we do want to see the silver start to show strength relative to gold, but and we also want to see the mining stocks start to outperform the gold market coming off the initial low, and that has been a very, very important factor in the last few big rallies that we've had, where that run that gold made to 1900. Clearly, it was the first year or two that miners were outperforming, and it was the last 3 or 4 months where they underperformed. So that was the warning signal when we were back in 2011.
Do you expect oil to drop as we get into seasonality and less gasoline being used?
Well, that's been the scenario that we've been working towards. It's been a little slow in doing the turn, but we did get the nice overbought readings. We have what we call a sequential 9. That was 9 consecutive bars or days of higher closes going back about 2 weeks ago. Typically, when you get that 9 count, it takes 2 to 5 days for the oil market to roll over, and that's exactly what this one has been. It's now, we're trading around 50 or 49 and a quarter at the end of the week. This has now managed to violate that last breakout. It had been up to 50 or 50 and a quarter a few times during the summer. Managed to pop through to 52 when it went to that TD9 reading. And now we're back through 40, into the 49 and a quarter level, as I mentioned.
Ross, thank you so much for being on This Week in Money.
Always nice to be with you, Jim.
My guest has been Ross Clark. He's an investment advisor at CIBC Wood Gundy, Vancouver. If you have any questions for Ross, you can send them to chartworks@gmail.com. Coming up, Hilliard MacBeth, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Welcome back to the show, Hilliard.
Nice to be on the show again.
And you're on the road in Vancouver speaking at a seminar. What was going on at that seminar?
Well, I had invited a guest to speak. He's a hedge fund manager from the U.S., actually from Boston, and he is, along with a few other people, trying to figure out a way to take advantage of the coming crash in real estate in Canada in order to make money. And so he was meeting with a few potential investors that might want to invest in his hedge fund to explain to them how it works. And I also gave a presentation myself about the research I found in my conclusions in my research, and it was a very interesting evening. And there were people there who were relatively kind of average financial people, and there were some very wealthy people there. And it was a small enough group. It was less than 20 that we were able to have lots of interaction as well. So there was a couple there that were renting. They hadn't bought yet, so they actually had. It's interesting with renters. They actually have quite a bit of money saved up because they both have good jobs, and they were describing how the pressure is. How many of their friends have bought and they're so house poor that they have no money at all to. Their friends have no money at all to. And also they have a lot. Their friends have a lot of debt as well. Another fellow I met, not at the seminar but before the seminar, has a house outside of Vancouver, but it's a big house apparently, assessed at $3.5 million. So I tried to suggest to him that maybe he could sell that, and that would be his retirement fund, and he could rent a house. But he was convinced that there's nothing to rent. But of course, at that seminar last night, there was a fellow he and his wife are renting for $3,500 a month in North Van, and it's a $2.5 million assessed house. And it's apparently a beautiful house, lots of room, 3,500 square feet. So I don't think that there's a shortage of rentals if you're willing to go up to $3,000 or $4,000. And for the people that have that much money built up if they've been lucky enough to own a house in Vancouver for a number of years, it's a wonderful opportunity. But the people that are in that position are reluctant to take that step of selling, partly because of lifestyle, partly because they don't believe the prices will ever go down. But the hedge fund guy, getting back to that, he's convinced that house prices are coming down. He lived through the bubble bursting in the U.S., and he was telling us how there's quite a few similarities in terms of the factors that would cause the Canadian housing market to, he was talking mostly about Toronto and Vancouver, but it'll affect Victoria and Kelowna as well, and Edmonton and Calgary. Obviously, it'll affect everybody when it happens.
Well, of course, real estate, as we know, is regional. Yet, I was asked, Vancouver prices have come down a bit, but they're still rising in Victoria. Why? Well, Victoria mirrors Vancouver, but there's a 6 to 9 month delay. So what happens in Vancouver, you'll see in Victoria, but it takes a while to get there.
Yeah, and prices, I mean, they are cheaper, and then also the cost of living is lower, and people are attracted. There's a lot of transactions where it's first people going from owning one thing to owning another thing, and there is a bit of a difference in the money, but it's not a huge difference. But the fellow from the U.S. was describing how he was involved in consulting. He was an analyst for a hedge fund that was doing some shorting of the U.S. market in order to take advantage of it, and there are some differences as to what happened there in 2006. He's also involved with Iceland and teaching some courses up there, and the common denominator in all of that was the amount of debt that was attached to the real estate that was floating around. And one of the questions that came up last night was, yes, but the interest rates are so low and the monthly payments are so low that people can handle the debt. And what happened in the U.S., which is not widely understood, I don't think, is that the interest rate cost never really went. I mean, they were a little bit higher than they are now. Instead of being 3 or 4%, they were 4 or 5 or 6%. But because in the U.S. the mortgages are for 30 years, it doesn't really make that much difference to your payments because it's spread over 30 years. But the interest rates never really went up that much. It was not the cost of credit that caused the bubble to burst. It was people changed their view on what the lenders changed their view about how much they're willing to lend and who they were willing to lend it to, and in most cases they were forced to change their view.
Well, also when the recession hit, hundreds of thousands of people lost their jobs. You can't make the payments.
So this is one of the things that the hedge fund guy brought up, which is quite interesting, and that is that everybody's assuming that there's going to be some trigger that will cause the bubble to burst, but the real estate sector, and people in Vancouver know this, and people in Edmonton, Calgary, Toronto, we can all see it all around us. The real estate construction and real estate flipping houses, and all of this, the banking, the lending, the sales commissions for the realtors, it's a huge percentage of the economy. It's up, that sector is up in the, the direct investment is 8%, but the total, if you include everything, is more like 25% of the GDP. And so it could work the other way. For some reason, the real estate market slows down, and the slowdown in real estate causes the economy to go into a recession, because we're so dependent now on real estate activity to keep the economy going. And I think you could say Vancouver especially is like this. It's very dependent on. So what would be the trigger? So what happened in the U.S. was there's some government-sponsored agencies, Fannie Mae and Freddie Mac, and they got into trouble, and then Lehman Brothers got into trouble, and nobody trusted anybody to lend any money to anybody else, and so the lending conduits just dried up. Now that's not as likely to happen in Canada, because we've got CMHC and we've got 6 banks who are very much in control of the whole thing, because they own 80% of all the lending. So what is happening, though, would be a trigger in terms of the availability, is the regulators changing the rules. And they just announced, there's a speech yesterday in Toronto, and the head of OSFI, as it's called, Office of Superintendent of Financial Institutions, said that they're concerned about high household debt, and they're concerned about very expensive real estate prices, and they're not going to wait. I'm paraphrasing, but this is roughly what he said. They're not going to wait until everybody starts defaulting on their mortgages to act. They're going to act before that time. So they've got these new guidelines that are coming out, called, for some reason, it's called B20, and they're basically telling the lenders what guidelines they are to apply to assessing whether somebody's worthy of a loan, whether they qualify for a mortgage or a HELOC or a car loan or whatever. And obviously the rapid growth in credit over the last 10 or 15 years in Canada means you get to the point where there's nobody left to lend to except the very marginal, risky borrowers, and so they're going to make some changes to that. And along with all the other changes they made last fall, that could be the trigger to cause things to slow down. And unfortunately, in the real estate market, slowing down is really bad, because it's like a treadmill that's turning, and you can't get off it, and the speed just kind of keeps getting increased, and you have to run faster and faster just to stay even. And so if the rate of growth of the household debt even slows down a little bit, that would be enough to cause a recession in Canada. It's a really unfortunate situation.
We'll have more with Hilliard MacBeth next on This Week in Money.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test the numerous targets located by recent groundwork will commence later this year. Please visit our website at rmroyalty.com.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Hilliard MacBeth. He's the author of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. Hilliard, from what you're telling me, it sounds like the government is going to put in the regulations that caused the recession that they hope the regulations will help prevent.
No elected government official wants to be the person that's there when the bubble bursts. But assuming the bubble has to burst, somebody has to be the one that's there, and they have delayed putting in these changes. It's really interesting to read the speeches from the regulators because they spend 3/4 of the speech congratulating themselves on how stable and how safe and how prudent the financial regulatory system is in Canada. And then they spend about 25% of the time saying, yes, but we have to change it. So if it's so safe and so prudent and it's been done so well, why does it have to change? And of course, what they don't say, but it's obvious, is that there have been, because we've had such a long period of stability in the lending, and we got through the worst thing that happened, I'm sure I've said this before, the worst thing that happened to Canada was the way we sailed through the 2008-2009 crisis with almost hardly any impact. It would have been much better for everybody if we'd had a fairly big scare at that time. But we didn't, so things carried on as they were, and what happens is people get more and more complacent. People get more and more convinced there's never going to be any problem, and so they start stretching the rules, bending the rules, and home capital is a perfect example of the troubles that they had. It's a perfect example of how people can get themselves into real trouble, more or less within the rules. So the regulators are saying, okay, we thought those rules were good. They were very prudent and careful and all that, but we need to, obviously we were wrong. They don't admit it, but they obviously were wrong, because we wouldn't have this huge residential debt burden if they weren't wrong. So we have to tighten it up, and that's what they're doing with these new guidelines. And there's been a bunch of changes that tighten things up. So when the average person goes to get their mortgage, they're going to either not qualify, or it's going to be more expensive, or they'll have to put a much bigger down payment, and or all of the above. And of course, that means that the sellers will have to drop their prices if they really want to sell. Now, if people don't have to sell, if there's no reason to sell, maybe they'll just pull their house off the market and say, okay, well, now's not a good time. They've tightened up the regulations. There's not very many buyers around. I'll just stay put. But unfortunately, after such a long speculative boom in real estate, there's always going to be some people who take on too much risk and try and make as much money as possible by reaching a little bit or reaching a lot. And those are the people that end up getting forced to sell in a bad situation like that. So one of the things we talked about last night was how, unfortunately, this happens everywhere. It's not just Canada. The rules and the lenders get too complacent and too relaxed when the boom is on, and then they get too tight and too cautious and too careful about who they lend to when the downturn comes. So in other words, they make the highs higher and they make the lows lower.
Hilliard, if a person, say, was to sell a house worth $1 million, how much income would they get off that $1 million, and would it be enough to rent a comparable property?
So that's a great question. The way I calculate it is 4%. So, and this where I get the 4% from is there's lots of preferred shares. So preferred shares, I have to add in a little bit of background here, is like you're lending money to a company. So the Royal Bank of Canada or Scotia Bank or TD issues these preferred shares, so they're borrowing money. And when you give them your money in that regard, in that way, you get a dividend that's fixed at a fixed rate. There's some that have adjustments, so it's sort of complicated, but anyway, just the simple version is the fixed rate. And 4% is actually a little bit lower than what you can get. You can get a little bit higher than that now. And there's some very attractive preferred shares and they're safe. I mean, the bank would have to lose all of its common share money and all of its dividends on its common share before the preferred shares got into trouble. And of course, that's very unlikely to happen. So it's a you don't have to take any risk, basically, or very little risk, let's say, and you can get 4%. And then, so you got them used to the $1 million, you got your 4%, and then you're also avoiding the insurance, taxes, maintenance costs. So, and I calculate that to be about 2%. Taxes are quite low in BC; they're quite a bit higher in Alberta, but Generally, you could say taxes are between 0.5% and 1%, and then insurance and maintenance is another 1 to 1.5%. So rough guideline 2%. So now you've got 6% to work with. So if you've got $1 million house, if you've got $1 million sitting there, you want to put it in a house or you can put it in investment, you should be able to get about $60,000 a year or $5,000 a month income off of that. And the renter that I talked to just actually this morning, they have a $2.5 million house that they're renting. They didn't buy it, but it's assessed at $2.5 million, and they're paying $3,500 a month in rent. So that would be more in the range of $10,000-$12,000 a month at $2.5 million that you get with that money. And if you rent at $5,000, you're saving $5,000 to $7,000 a month in renting versus what it would cost to own that house and what income you would give up by sinking the capital into that house and not having the capital available to invest. But that's before you consider if prices go up or down. So if prices go down on that, let's say go back to the $1 million example, the prices go down 10% a year for a couple of years, that's $100,000. So that's another $7,000 a month you're saving if you're renting. So now, the reason people don't like that is because up until now, prices have been going up. So if you're renting and prices are going up, of course, the math works totally the other way. You can't possibly make enough money off your investment, or it would be very difficult to make enough money off your investment to keep up with house prices if house prices are rising at 10% a year. And they have averaged that for the last few years, up until, say, a year ago. So the whole renting thing works really well if prices are flat or are going down. It doesn't work very well if prices keep going up forever. But we have to understand that prices cannot keep going up forever.
And of course, maybe the scariest thing that a person can hear is, this time it's different.
Yeah, it's amazing. The prices did go down in Toronto, Vancouver, pretty well everywhere in the 90s, and they went down in the 80s as well, and by different amounts, depending on whether you're in Vancouver, Calgary, or Toronto. But prices have really basically not gone down much at all, if ever, since about 1995 or 1997, depending on where you are. So we've had 20 years of no experience. So everybody knows prices went down before 1997, and they did it not once but twice, at least in my memory. But because it's been 20 years, people become convinced that this time it's different and they're not going to go down. But of course they have to go down. That's just the cycle. People. I was in North Van, and the construction is unbelievable. There's 2 major buildings under construction just after you get off the Seabus terminal there. And the supply keeps getting added, and at some point it'll overwhelm the demand and prices will go down. So it's I just hope that people I don't think very many people will, but if people took advantage of the wonderful prices right now to get their finances in order and set aside a pot of money for retirement, that would be the best thing they could do. Of course, I can't give advice to individual people because I have to know their circumstances, but in general, a house is a place to live, not an investment that pays you any money. So if you've got a whole bunch of money tied up in housing and not really much available elsewhere in your investment portfolio, now would be a great time to rebalance that.
Hilliard, thank you so much for chatting with us.
Thanks, Jim.
My guest has been Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, macbethgroup.com. Coming up, Ed Steer from edsteergoldandsilver.com. Next on This Week in Money.
I'm Larry Reaugh, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
I'm Brian Fowler, President of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blende project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlin district of northwestern BC. Check us out at blindcreekresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Ed Steer, founder of EdSteerGoldandSilver.com. He's also a director of GATA, the Gold Antitrust Action Committee. He's speaking to us from Edmonton. Ed, welcome back to This Week in Money.
Always glad to be on your show, Jim.
Ed, why do gold and silver seem disconnected from the fundamentals of geopolitical unrest and economic concerns, and are they likely to play catch-up?
Well, that's the same answer. I think you asked this question last month, too, and the answer is the same as it was last month. The reason that the precious metals are disconnected from fundamentals of these types is the fact that the prices are being actively managed and they're not being allowed to react. And if they do react to a situation, then the bullion banks are there to smack the price down so that there's no excitement and no mass movement of people moving from, say, the Dow Industrial Average in the bond market into something that's a hard asset like precious metals. And will it ever end? Well, that all depends. It'll end when they decide it's going to end, but that time isn't right now. So until they decide, the fundamentals and what's going on geopolitically and economically mean absolutely nothing.
How are the gold and silver markets priced and manipulated?
Well, it's very simple. The price for all most physical commodities set on the COMEX, and which is run and operated by the CME Group, and it's set in the COMEX futures markets. All prices of most major commodities, and certainly all four precious metals, are set there. And the fact of the matter is that there are 8 traders, most of them U.S. banks and investment houses, almost all of them U.S. banks and investment houses, all trading in collusion that are short, between the 8 of them, 55% of the entire open interest in gold and 55% of the entire open interest in silver. And since they're acting in collusion, it doesn't make any difference what the other 45% of the market is doing, which is composed of thousands of separate traders. These guys control the price by the fact that they all act together as one single solitary unit. So it's done on the COMEX, and until that changes, nothing's going to change, Jim.
Are these guys so connected to government that there's no way you can expect the government to do anything about it?
I would think the government's involved to a certain extent, but that is irrelevant. The fact of the matter that the government may be involved, or the Bank for International Settlement may be involved, the fact of the matter is the price is set in the COMEX futures market, and regardless of whether they're behind it or the bullion banks or little green men from Mars, until the price isn't set on the COMEX, they will continue to be manipulated.
Can you invest against manipulation?
Well, I'll tell you what, there's lots of people that try, and the only way you can do it successfully is follow what the crooks on the COMEX are doing, the 8 or less traders. When they're going long, you go long. When they start to cover short positions, you cover shorts. The problem is on the COMEX, it's a very expensive game to play, and trading futures and options is not something that 99.9% of the population do. I suppose you could invest in mining companies and buy at the top and sell when the commercial traders are maximum short, or buy when the commercial traders are maximum short, and trade it that way. But the moves have been so tight here for the last year, up and down $100 or $120 in gold and $2 or $3 in silver, that the spreads will eat you alive and the commissions will eat you alive if you're trading stocks and things like that. So it's really tough to do, and only an experienced trader should even attempt it.
Do they, I don't know, I don't want to use the word sucker, but I am. Do they suck people into thinking that they can really invest individually without a lot of knowledge in the markets?
Well, there's sucker born every minute, I'm sure, but anybody who's been around the block in the precious metals market knows that this is a market that you can trade if you're very, very good and very, very knowledgeable and watch the markets every second of the day, from the time they open till the time it closes. But most people aren't in a position to do that. So, if people want to do that, they're more than welcome to. But boy, it would be certainly hard on the nerves to do that. I don't do it. I'm a buy and hold kind of guy, and most people are buy and hold. But to trade this thing, lots of people get sucked into it. But it's a mug's game as far as I'm concerned.
Has the new Shanghai gold fix affected the gold market?
I suppose it has in certain respects, but the fact of the matter is that despite the fact that it's a physical exchange, the price is still set on the COMEX in New York. And as I said in the last 2 or 3 questions, until that changes, nothing changes. I'm sure that Shanghai will make a difference someday, and I certainly hope it does. But at the moment, it all matters what J.P. Morgan, Scotiabank, and half a dozen other bullion banks are doing as they set the price.
Is the government of India still going after personal holdings of gold and cash?
That's kind of died off. They changed out the currencies. Was it for the 500 and 1,000 rupee notes were changed out for different notes, and what they did is they caught a lot of people with a lot of illegal money, making their rupees worthless overnight. That situation was about a year ago, and things have sort of recovered since then, and the gold market has really staged a massive recovery since it fell off a cliff last year. So I would say that this is not going on. The government would certainly like people to buy less gold, but so far to date, except for the currency exchange situation last year, it still is a total and abject failure.
Russia and China were trying to lay their hands on every piece of physical gold they could. Is that trend still continuing?
Yeah, there's nothing changed there. Russia buys about 200 tons of gold a year, and they mine about 275 or 280 tons. So most of their production ends up in their own vault, and the other 70 to 80 tons gets sold in the open market. Although it wouldn't surprise me in the slightest if they sold it directly to China, so that none of their production ever gets to the market. And all of China's production, without exception, stays in the country, plus whatever they import through Switzerland and London and Hong Kong and other points of entry. But no, they're soaking up gold as fast as they can, and there's another country that's doing it as well as Kazakhstan, and Turkey's taking a big chunk. And between those 4 or 5 countries, they're taking pretty much all the gold that's being mined in the world right now. So they're basically a black hole into which gold, and probably silver most likely, is disappearing and never reappearing again.
With the global debt bubble, where should non-manipulated prices of gold and silver be?
Well, let's put it this way. Nobody knows what the free market price of the precious metals would be because they've been managed since day one. I can tell you right now, without a word of a lie, they would be higher by many orders of magnitude. You'd see a 3-digit gold price, a silver price, well into the 3 digits. And the gold price that's, I don't know, pick a number. But as long as those 8 traders, those 8 bullion banks, are sitting on the price, nobody knows what the free market price of these precious metals are. And but all I can tell you is they would be massively higher than they are right now.
Do you see any fundamentals on the horizon that could make gold and silver break loose of the manipulation and go parabolic?
Well, gold and silver try to break out all the time. Case in point, we had a pretty strong rally in London, and the boys showed up at 1 o'clock in the afternoon London time, or 8 o'clock in the morning in New York, and as you know, they had all the precious metal prices back to unchanged or less by the time the COMEX closed. So every time there is some economic or political news that certainly tries to blow the prices sky high, there's always somebody there to smack it down. And there's black swans everywhere: economic, financial, monetary, political. The world is full of landmines out there right now, and if it wasn't for these guys sitting on the price, these prices would be substantially higher. And whether something will come along that will finally break it, I just don't know, but it hasn't happened yet.
Could the manipulators send gold and silver parabolic in order to sell for huge profits?
Well, the only bank that's in position to make huge profits right now is J.P. Morgan Chase. Ted Butler, whose work I follow, believes that I'm certainly not arguing with him, because he certainly has enough circumstantial evidence to back it up, that J.P. Morgan's sitting on about 650 million ounces of physical silver right now. And they could let the price blow sky high, and even though they have a big short position in the COMEX futures market, they could cover that nicely with the physical they got and still have 550-odd million or 500 million ounces of physical left. And they would make enormous profits on it. The problem is that everybody else of the remaining big seven and everybody else that short the markets would crash and burn in the biggest short squeeze the world has ever seen. So there's only one bank that would make large profits. Everybody would be basically toast, and I think that's what they're trying to avoid at the moment.
Anybody who was back around in the 70s remembers the Hunt brothers trying to corner the silver market because it's so much smaller than the gold market. Is that ever possible to try to do again?
Well, it certainly is. The Hunt brothers did it, and then Warren Buffett came along, I think it was in the late 90s, and picked up 135 million ounces of silver on the sly, and that's why silver ran up to, $20 or $30 at the time. And he could see what was going on in the market. And in the end, he got snookered out of it, and when he did get snookered out of his 100 and some million ounces of physical silver, that was the seed stock for SLV when it was first set up back in, I don't know what year it was, 2006, but that's where the original source of silver came that went in there. J.P. Morgan is the principal short on the in the COMEX futures market. They took over the short positions in gold and silver of Bear Stearns when it almost went under in 2008, I believe. And the only reason that the Bear Stearns was rescued instead of letting go like Lehman Brothers was the fact that if they'd gone under, it would have forced the bankruptcy courts to go into the market and cover, I think it was like 35,000 short contracts in silver and 20-some thousand contracts of gold. And, of course, if they'd had to do that in a very liquid market, then we would see gold and silver prices that were the kind of parabolic ones you're talking about. So Treasury Department and probably the Fed went to Jamie and said, look, we have to get out of this. We want you to take over this company. And Jamie said, sure, but you have to give me carte blanche to get out of carte blanche ability to do anything I want, plus a get out of jail free card. And since then, they've been accumulating mass amounts of silver because they opened their silver warehouse 4 days before the price of silver crashed at the $50 mark back on May 1st, 2011, and they've been accumulating silver ever since. And right now, I think they got about 115 million ounces there. Ted Butler says they got much more in Silver Eagles and Silver Maple Leafs. Plus, they got a warehouse in London that's chock full of silver as well. So they've been accumulating this stuff on the sly. And they're also the one of the principal people involved in SLV, and they control that, and so they are able to skim out of that. So between all of this stuff, Ted figures they got 650 million ounces stashed away, and I don't see any reason to doubt that number.
How are the commitment of traders numbers looking for gold and silver?
Oh, I'm afraid they're not very good. they were, we had the big rally, and of course all the managed money traders, Ted says, they went massively long and covered a record number of short positions. So the big 8 traders gorged themselves on the short side of the trade when they got massively short, and the managed money traders got massively long, and the managed money traders ran out of money to invest. That was the top. And now we're doing the big flush out, the wash, rinse, and spin cycle that everybody's very familiar with. And we're only partway through that. The prices are down quite a bit, but it's not the price that matters. It's the number of contracts that the managed money traders have on the long side that have to be liquidated yet so that J.P. Morgan and the other traders can cover their short positions. So from a contract point of view, there's still a long way to go, but the trend, the wash, rinse, spin cycle that we've seen so many times in the last 10, 15 years is in progress right now.
You're listening to This Week in Money. We're chatting with Ed Steer from edsteergoldandsilver.com. Ed, how are physical and gold silver sales doing?
Well, they suck, if you really want it in one word. The retail precious metal business has been basically lousy for the last 2 or 3 years. And one of the reasons that coin sales from the U.S. Mint and the Royal Canadian Mint have been so strong for the last 5 or 6 years is because J.P. Morgan's been buying them all. They stepped back from the market last September, and as the reports on the Internet have shown, and from the U.S. Mint, that sales have absolutely crashed. I think Silver Eagle sales are down 80%, and Gold Eagle sales are down 85 or 90% from what they were a year ago, and that's principally because the buying public wasn't there last year, and then, of course, J.P. Morgan, once they stopped buying them, just made the sales numbers look even worse. And that's carried over into the sales reports that you get out of the Royal Canadian Mint as well. It's just really unfortunate, but the retail market is just deader than the doornail.
Do you look for specific signals to turn short-term bullish on gold and silver?
Well, we've had a partial clean out of the managed money long traders right now. And, J.P. Morgan and the boys have covered it, reasonable number of short positions. We could have a rally any time. I mean, a counter-trend rally is always possible when we're in a bear market like this. So, we could get one tomorrow. We had one yesterday. It got killed. We could get one tomorrow. But the fact of the matter is, we're miles away from a bullish commitment of traders report. And until I see that, and until Ted Butler sees that, the managed money traders are pretty much washed out on the long side, and J.P. Morgan and Scotiabank and all these other bullion banks have been able to cover as many short positions as possible, I'm not going to be bullish on the market. But, there could be a black swan out there. But as we've already discussed at the top of the show, whenever there's any bad economic or financial or monetary or political news out there, the boys are there to make sure it doesn't translate into higher precious metals prices. So am I bullish? Not at the moment, but, one of these days I will be. Ask me that question in a month. Ask me next month and we'll see how it's doing.
Are gold and silver discoveries becoming harder to find?
Oh, absolutely. I mean, there's no way on God's green earth right now that any of the mining companies, large or small, or any of the exploration companies out there are even coming close to replacing every year what is being mined right now. I think, what are they mining in gold? 1 million ounces? No, about 100 million ounces a year. And in silver, it's about, 900 million ounces. I know for a fact that gold discoveries are down, 85 or 90%. They're only replacing, 5 or 10 million ounces out of every 100 million they're selling. So the crisis is coming as far as supply is concerned. And I've heard a lot of people talking about on the Internet, the president of the large mining companies. And I heard Randall Oliphant, who's the CEO of the World Gold Council, saying exactly the same thing the other day, that, hey, the demand is there, strong, and it's getting bigger every year, but the fact of the matter is supplies just isn't there, and sooner or later it's going to be crunch time, and it takes many, many years, 5, 10 years to bring a mine into production. But even if they do bring the mine into production, there just aren't enough mines or ounces being discovered to cover what's being sold, so it's one of these days, whether it be 2 or 3 or 4 or 5 years down the road, there's going to be a real physical crunch.
Are gold and silver being used more as in industrial metals because they're such good conductors of electricity?
Well, they've always been. That's always been the case. Certainly, silver has more and more industrial demand all the time. Its new uses are legion. I mean, just take a look at I look in my own lifetime, just in the last 25, 30, 40 years, just how much silver has become a critical, small but very critical component of almost every electronic thing that's made out there. Gold has never been used industrially on a large scale, so its industrial use is a very small fraction of the total gold mine. Most of it goes into jewelry or investment demand. But silver, one of these days we're going to see enough demand that it will certainly overwhelm supply as well.
Now, countries like Canada and Britain have sold off their gold reserves. Was that a wise or unwise move?
Well, to tell you the truth, I don't want to go too far down this rabbit hole, but I think that one of the reasons Canada sold its gold was in an effort to bring down the Soviet Union. That was way back in the 1980s, I believe. Canada had 600 tons of gold at the time, and Britain had, I don't know how much, 400 or 500. I don't know how much gold Britain had back 30, 40 years ago. But certainly Canada had a very good chunk and a very worthwhile amount of gold backing its currency. And that was a decision that Prime Minister Brian Mulroney made at the time. And I think it was the stupidest thing he ever did. And, of course, the Bank of Canada has made no attempt, and no government has made an attempt since, to rebuild those reserves, and right now we're down to nothing. As far as Britain is concerned, I'm just not able to speak on that issue, but the fact of the matter is they sold a bunch of gold. Back when the Washington Accord was signed and the gold price spiked, they had to sell, 200, 300, 400 tons of gold just to get the bullion banks out of trouble, because a lot of them were going to go bankrupt, and the entire price management scheme would have folded right there. So that was the reason Britain sold a lot of gold, and they're down to almost nothing for a country of their size. They should have way, way more than they've got right now.
Could a country like Canada be considered to be holding a lot of gold even though it's still in the ground instead of a vault?
Well, I'll tell you what, I certainly don't think so. There's a lot of countries out there with a lot of gold in the ground, like China or Russia, South Africa, Australia, the large major gold-producing countries of the world. Gold in the ground isn't the same as gold in the vault.
Could the breakdown of the European Union affect gold and silver?
It should be affecting it right now with all the problems in Spain and all the problems going on elsewhere in Europe. When you take a look at the amount of death in the European Union, Italy, Spain, Portugal, the pigs they called them 2 or 3 years ago, and that's a phrase we haven't seen for a long, long time. But the fact of the matter is that Mario Draghi is now buying every bond in sight, and has driven bond yields into the dirt.
Ed, thank you so much for being on This Week in Money.
My pleasure.
We've been speaking with Ed Steer of edsteergoldandsilver.com. He was speaking to us from Edmonton. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Hilliard MacBeth, and Ed Steer. And thank you for listening. And stand by for Company Showcase updates with American Manganese CEO Larry Reaugh, Aben Resources' Brian Fowler, Blind Creek's Bill McWilliam, and Glance Pay's Penny Green. I'm Jim Goddard. If you have any questions for the show, you can email us at info@howstreet.com. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm your host, Jim Goddard. Larry, welcome back to the show.
Glad to be here, Jim.
We're speaking with Larry Reaugh. He's the CEO and president of American Manganese. Larry, I understand you're off to speak at an investor show in Balboa Bay Resort in Newport, California. What are you going to be telling those good folks?
Well, we'll certainly be updating them on our technology, which is fantastic. Eventually, I'm hoping that it's going to bring in the rewards that we want.
This is a show put on by Benchmark out of London, and they've got a pretty stellar group of speakers there that, and I would hope to make some great contacts.
And besides going to that show, what else can you tell us today?
Well, I can tell you that we're on track with the filing of the permits. You have to remember that this is a major job because we've actually done thousands of tests on the work that we did, but that's well on track, and I expect that that will be filed on or before November the 10th. And the other thing that I would like to talk about is I've been getting some queries from my investment base about all these new chemistries and batteries and new techniques that are coming out and how that affects American Manganese and its recycling program. First off, I'd like to say that anything that's new has at least a 10 or 12 year gestation period, in which at that time there will be millions of batteries for us to work over with the existing chemistries. You know, but the ones like Toshiba just announced that they have a fast-charging battery that has a different anode on it, and that anode is composed of vanadium and niobium. Now, I mentioned in our latest press release that we'll be looking at graphite to recover. Well, that makes a bit of a difference there, but the cathode should be the same. But again, how do you adopt this? Because all of the existing infrastructure for recharging batteries is for the lithium-ion with the graphite or graphene anode, and that will be a huge changeover because it's going to have to put out a heck of a lot more power than the existing ones. And I think we're going to be seeing everything under lithium-ion for perhaps the next 2 decades. And so I just want everybody to realize that these new technologies, yes, there's going to be new ones, and probably there will be improved lithium-ion batteries going down the road. But I would really like to see in the technologies as the manufacturers all follow a code on the size of battery and everything else that they're making, so that it makes recycling easier. And we won't see that for a while, but that would be a big boost for us to see that happening. Now, that's a little bit about the technologies that we're doing, and I'd just like to say that we basically try to keep abreast of everything. We can't begin to test different chemistries at this point because that's a very expensive, time-consuming operation. And as I said previously, we could be 10 to 20 years before we encounter any amount or great amount of new chemistries, and which gives us lots of time to do that. Right now, we just don't have the time. We've got to file for what we know we can do and get those patents applied for. So all in all, Jim, it's a long weekend coming up, and I hate to be off in the middle of the long weekend, and I'll be back probably quite late on Tuesday night, maybe Wednesday morning. And but I expect that we will have a excellent reception down there. They're talking about lithium and other aspects. This is a cathode, Benchmark's cathode seminar, which talks about cobalt. And on that front, I see that there's a lot of technology breaking the news now on recovering the lithium from brines in a much more superior manner than was previously known. And some stocks are really performing on that. And I think that's just looking as a fortune teller, looking in the globe and saying, hey, crystal ball, looks like we can expect great things for our company because we're going to produce everything. And that was another point that I wanted to make, is people don't even think about us as producing lithium. But for every pound of lithium that goes into a battery, we'll get it back. And, so that would, that's another big plus. We will be in the lithium production range. We'll be in the nickel production range. We'll be in the manganese production range. And certainly in the cobalt range. So it's, I think this is things that people are not appreciating, or new investors. We've got investors that have appreciated what we can do here right from the get-go a year ago. And, but the new investors are not quite seeing the full picture yet, although we try to make that quite clear. So we're going to move on with what we're doing. We can't get distracted on new chemistries or new developments in the lithium-ion battery field because it's not immediate. And like I say, it's probably 10 years down the road. So, but we'll be watching. We'll watch everything that comes out. And if we see something that's rapidly developing, we better get back to the drawing board because we want to capture that, even if it's 10 years out. What we do is wish everybody a happy Thanksgiving, including yourself, Jim, and certainly my investors and shareholders and those people that are interested in what we're doing. And there's a lot of those. And I think that the end of this year is going to be very excellent, and we're looking forward to a great year next year.
Larry, can you remind people where American Manganese is traded and how they can find out more information?
American Manganese is traded under the symbol AMY on the TSX Venture Exchange, and it's traded under the symbol AMYZF on the U.S. Exchange and 2AM on the Frankfurt Exchange. You can get all the information and all the press releases and all of our advancements on our website at www.americanmanganese.com, and AmericanManganeseInc.com, I should say. And you can contact me at LREAUGH@AMYMN.com, or give me a call at 778-574-4444.
Larry, thanks for the update.
You're welcome, Jim.
I've been speaking with Larry Reaugh. He's the CEO and president of American Manganese. I'm Jim Goddard. We were speaking on October 6th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm your host, Jim Goddard. I'm speaking with Jim Pettit, CEO and president of Aben Resources. Welcome back to the show, Jim.
Thanks, Jim.
What is new with Aben?
Well, we just put out our first set of results the other day. I think that it was the 4th. It involved the first 4 holes of a 9-hole drill program that was roughly 2,500 meters in total. These first 4 holes had 3 holes from the Carcass zone, and the first hole on the boundary zone, which is a much bigger zone and is going to become our main source of focus in going forward anyway.
Jim, for people not familiar with Aben, what can you tell them about the company?
Well, we are pretty focused. Our main project is in the Golden Triangle, British Columbia. That's up in the northwest quadrant. The company's symbol is ABN. In the States, it's on the OTC pink sheets, it's ABNAF, and in Frankfurt, it's E2L2. We've got 23 million shares outstanding, and fully diluted, it's about 82 million in the current share prices. Trading in the 26 to 28 range. Since we put the results out, it came down a bit from the mid-30s to the mid-20s, and now it's sort of consolidating again and looking like it wants to move a little higher, which is great. But it's nice that there's that overhanging speculation that's been there for quite a while as we waited for assay results. So that's now out there. We've got 5 more holes to report on, which I'm suspecting the end of the month.
that sort of time frame, because it's been taking 6 to 8 weeks to get the assays. So, we're going to put them all out together so it makes sense. That'll be the balance of the drill holes on the boundary zone.
And Jim, can you give some background to the company? Where have you been? Where are you going?
Well, Aben initially got together. Well, we were concentrating in the gold space, and we have a lot of land up in the Yukon. We were very active up there during the big rush in the Yukon, say going back to 2011 and 12. We've still got a great project up there. And we've also got a great project in Saskatchewan that's drill ready for this winter. We're going to go in there in January. But our main focus is the Golden Triangle. I mean, that is the area that it gets the most interest, really, because it's considered elephant country. There's some very, very big projects and discoveries that have happened there. Eskay Creek being the principal. Snip is another one. Our chairman of the board, Ron Nedlitsky, was in on the discovery of both those, actually, way back. You've got new discoveries there called Pretium, and it's up by the Galore Creek. We're right in the middle of the heart of the whole Golden Triangle. And the north border, we're on the Galore Creek Road. In the south of the property, we're right in the Alta Gas Camp, basically, where they built this big new power project that supplies energy to the whole northwest quadrant now.
Jim, if somebody needed to get a hold of you or your company, how should they do it?
Well, you can call us at 687-3376. That's 604-687-3376. Or go to the website, www.abenresources.com. I just want to also state, too, that the initial results that we put out, the 3 holes in the Carcass zone, as everybody knows now, were less than stellar, so we're focusing now 100% on the boundary zone. And that initial hole we put out, basically, we intersected 10 meters of 6.7 grams of gold and 0.9% copper, and that was in the first 25 meters of the hole. The hole actually went to almost 400 meters, and it was pretty much mineralized throughout. If we took the whole 396 meters, you'd have 0.25 gold. There was many zones that were mineralized, so we consider this one heck of a good start. The core of that nice intersection we got was actually 3 meters. 3 meters of 16.6 grams, 18.9 grams gold. So that's a really good start, and we've got 5 more holes coming, like I said, and we've got a lot of faith in this zone. We do know that there's a lot of gold and till anomalies like throughout that whole region, and they probably stretch south another 1.5 kilometers of where we extended our drilling to. That zone also had a historic drill hole in it. That was about 11 meters of 33 grams gold, so really quite significant. And it is actually positioned right in the middle of our drill program. So, we've started our drilling 280 meters north of that historic drill hole. And then we've extended another 150 to the south, and the drilling is oriented to the south. So the zone we've now got identified is roughly, let's call it 500 to 600 meters in length, and tremendous gold and till anomalies, or gold and soil anomalies on surface. And that's basically what brought us to this region, was the historic hole. Wanted to know why it's there, and then when we did all the sampling on surface, rock sampling and soil sampling, it shows up. It's tremendous, and it carries on well to the south of where we're drilling. So we've got quite a bit to do there going forward in the future.
Jim, thanks for the update.
You bet, anytime.
We've been speaking with Jim Pettit, CEO and President of Aben Resources, on October 5th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of House Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm your host, Jim Goddard. We're speaking with Blind Creek President Brian Fowler. Brian, I see in last week's news that Blind Creek completed a field program at the company's Blende zinc lead silver property in north central Yukon. What can you tell our listeners about that?
Hi, Jim. Last week Blind Creek announced that a geological team from Moose Mountain Technical Services had collected a number of samples for specific gravity or density determination, and 175 kilograms of metallurgical samples from select and representative diamond drill core that's currently stored on the Blende property. Moose Mountain will be conducting SG determinations for mineral resource estimation and classification purposes, and metallurgical samples have been submitted to BV Minerals in Richmond for assay analysis, metallurgical processing, and studies. Bit of background on Blende, Jim. Blende is one of the largest undeveloped zinc lead silver deposits in Western Canada. There's a historical deposit resource estimate that was performed by Billiton in 1991 that reported the deposit contained 19.6 million tons, averaging 3.04% zinc, 2.8% lead, and 56 grams per ton silver. And metallurgical studies were only focused on the sulfide portion of the deposit known at that time. The Billiton resource estimate represents 1.3 billion pounds of zinc, 1.2 billion pounds of lead, and 35.3 million ounces of silver. And I should caution your readers that these are historic resource numbers, and it's not NI 43-101 compliant resource. The company is treating it as such, and the estimates should not be relied upon. Having said that, Billiton's resource tonnage and grain calculations were confined within a 1% combined lead-zinc 3D envelope to determine an overall open pit resource tons and grade. And the company's opinion that such a broad, low-grade envelope introduced a great deal of dilution at the expense of overall zinc grade. The Blende deposit has excellent potential for both open pit and underground exploitation, the latter of which has never really been adequately evaluated. Blind Creek has developed tighter, geologically constrained 3D solids for a new resource estimate that's expected to increase the overall grade of the deposit. Much has transpired since the 1991 Billiton resource estimate. Firstly, since acquiring the property in 2006, Blind Creek incurred $5.2 million in acquisition and exploration expenditures and drilled 38 additional holes in the deposit. Results from these step-out and infill holes have never been incorporated in a new resource estimate. Secondly, considerable oxide resource exists at Blende that can possibly be brought into resource categories with further exploration and metallurgical investigation. There's been a number of relevant technical advances in mineral processing of oxide, lead, and zinc minerals, as well as for concentrate treatment by various leaching or pyrometallurgical procedures. Blind Creek's ongoing metallurgical test work program has been designed to define and qualify any upsides from a resource tonnage, grade, and recovery standpoint. And lastly, as I mentioned previously, Blind Creek has remodeled the Blende deposit and developed a number of 3D solids, including oxide, transition zones, mixed zones, sulfide, etc., that Moose Mountain Technical Services will utilize to constrain tonnage and grade calculations for the new NI 43-101 compliant resource estimate that's currently in preparation, expected to be complete in early 2018. We're very confident that this approach, coupled with Blind Creek's current metallurgical studies, has the potential to significantly enhance Billiton's historic sulfide-only open pit historic tonnage and grade resource numbers for both possible open pit and underground mining. Getting back to our latest news release, Jim, Blind Creek also announced that Frank Wright, PN of F. Wright Consulting, Inc., has been commissioned by the company to conduct our preliminary scoping evaluation on the metallurgical samples, focusing on basic pre-concentration and flotation studies for all mineralization types, model and blend. This 4-month staged metallurgical program will entail characterization and optimization studies for comminution, dense media separation, flotation, liquid-solid separation, and concentrate characterization. This will all provide basis for further pyrometallurgical and hydrometallurgical recovery studies on blend concentrate samples.
Brian, is there anything new at your Engineer gold mine?
Yes, there is, Jim. This summer, Blind Creek conducted a geological mapping, sampling, and MMI soil sampling survey in select areas of the company's 100% owned historic Engineer gold mine property. It's situated 32 kilometers west of Atlin, BC. The company tripled the property size to over 12,000 hectares through staking this spring, and this year's soil survey was a first-pass exploration program designed to define additional narrow, high-grade gold veins and bulk tonnage gold targets on the property. We know from previous exploration at Engineer Mine that MMI works very well in this regard. We're also updating the Engineer Gold Mine NI 42101 report and resource estimate, and we hope to have this out very soon. This report will encapsulate results and conclusions of recent mine dewatering, bulk sampling, and on-site milling programs conducted by BC Gold Corp in 2011 and 2012. Engineer Mine has a high-grade NI 42101 gold resource and is fully permitted for small-scale gold production utilizing the on-site mill. Blind Creek is positioning the project for a substantial exploration and test mining and milling program in 2018, Jim.
Brian, what's the capital structure of Blind Creek?
Blind Creek currently has 22.5 million shares issued. I should mention 43% of these shares are held by company insiders. The stock has been trading in the 20-22 cent range, and the current market cap is about $4.7 million. Another bit of news is Blind Creek recently closed the second tranche of our private placement. So far, the company raised $414,000 through the issuance of 2,070,000 units, priced at 20 cents per unit. The company has now raised a total of $682,467 from the $1 million private placement, which is expected to close October 20th or sooner.
So in summary, Brian, it seems Blind Creek is well on its way to develop an NI 43101 compliant resource estimate at Blende and undertaking more target definition work at Engineer Gold Mine. Is there anything else you'd like to tell us?
Yes, there is, Jim. Blind Creek will have an investors booth at the upcoming San Francisco Gold and Silver Summit on November 20th and 21st next month. I invite investors and shareholders to come to hear the latest and learn more from Blind Creek Resources firsthand at booth number 513. I also invite your listeners to check out the company's website at www.blindcreekresources.com to learn more about the company and our project.
Brian, thanks for the update.
No problem, Jim. Talk again soon.
I've been speaking with Blind Creek President Brian Fowler. I'm Jim Goddard. We were speaking on October 2nd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on howstreet.com.
I'm your host, Jim Goddard. We're speaking with Penny Green. She's the COO, co-founder, and president of Glance Technologies. Welcome back to the show, Penny.
Thank you, Jim. It's great to be here.
You have a brand new news release to tell us about. What's in there, and what are your clients finding out about?
Thanks. You're absolutely right. Today, hot off the press, a new news release, Glance Technologies is very excited to announce that we've entered into an alliance with Netcoins Inc. Netcoins Inc. is a local company based in Vancouver, and it has this amazing ATM virtual software which allows retail outlets to sell Bitcoin. And they have been very successful in rolling out their technology, and there's approximately 4,000 stores right now that are Bitcoin teller locations using their technology. In fact, most ESO stores in Canada, you can go and buy Bitcoin now.
That's amazing.
Yeah, it's very exciting. And the alliance, basically, we've decided at Glance Technologies that we're going to make Bitcoin a currency or a cryptocurrency that we accept through our app. And the way it will work is we will allow anybody to take Bitcoin, convert it into Glance dollars, which already exists within the app, and then the Glance dollars can be spent at their leisure. But when you spend Glance dollars through the Glance Pay app, it happens in a lightning fast transaction. That's the real advantage over keeping your money in Bitcoin, because Bitcoin, right now, it can take right now the average time is between 5 and 20 minutes to complete a transaction. So if you want to buy something, you may have to wait 20 minutes to close that transaction, which is not really commercially viable. And there was even a couple times in the summer where it took several hours. So what our technology allows you to do is convert your Bitcoin into Glance dollars, and then when you are ready to use it, you can go pay for your meal, you can pay for your haircut, spend your money however you want through the app, and it takes a millisecond to complete the transaction.
Penny, for new listeners, can you tell us how your Glance Pay technology works and where it's used right now?
Absolutely. So Glance Pay is an innovative mobile payment system which allows people to download the app for free in iOS or an Android format, and then load their credit card in only once, and we have very good security. We have an incidence of zero fraud over 100 locations during the past 8 months. Once your credit card information is in there, it's very secure, and then from there on in, you just use your phone to pay.
And where can you use it?
Right now, you can use it in many locations in Canada, and we've just started signing up restaurants in the U.S.
Right. You just opened a head office in California. How's that rollout doing?
It's great. We've opened our head office in Silicon Valley, which is very exciting, and now we're just formulating our full U.S. expansion plan. So we're going to be choosing one or two of the top cities that we think will be really great for us to launch our innovative system there.
Have you added anybody to your board of directors recently?
Yes, we've had some really great developments lately. Just last week we announced Spiros Margaras, who joined our advisory board. Spiros Margaras is a venture capitalist, and he's also a fintech influencer. He's been ranked #1 global fintech influencer by Analytica, #2 insurtech global influencer by Analytica, and he regularly appears in the top 3 positions in many industry rankings. He is also ranked worldwide the #11 artificial influencer, and he's #10 blockchain influencer. So very, very knowledgeable guy. It's great to have him on his advisory board. We can reach out to him on a daily basis, and he's very enthusiastic about being involved in Glance. So his name again is Spiros Margaras.
Penny, how many businesses now are using Glance Pay?
Many businesses are using it. We have hundreds of merchants that have signed up to use it, and we've just successfully raised over $5 million through an incentive warrant program. So now we're going to be expanding and increasing that number hopefully to the thousands.
How popular is using your telephone to pay for things, say, in China?
Well, in China, you can look at the success of companies like Alipay to see how mobile payments has really taken over completely. The combination of the top 3 mobile payment systems in China do over $5.5 trillion a year, whereas they were at about $5 billion 5 years ago. So if you think about where we're at now, mobile payments are still new. Imagine where we're going to be in 5 years. And so I think that Glance Technologies is definitely in the right space, and I think our alliance with one of the more successful Bitcoin companies today announced is going to help us stay on the cutting edge of our technology.
Cryptocurrency seems to be where it's going.
It's very exciting. Blockchain is very exciting. It certainly changes the way that we can securitize and verify things online, and is actually making business much more viable online and much more secure. And so we're looking at ways that we can combine blockchain into our already very successful anti-fraud technology.
How can people find out more about Glance Technologies?
Go to glancepay.com or go to glance.tech. Those are our two websites.
Penny, thanks for the update.
Thank you, Jim. It's been a pleasure.
I've been speaking with Penny Green. She's the COO, co-founder, and president of Glance Technologies Incorporated. Their website, glancepay.com. I'm Jim Goddard. We were speaking on October 3rd.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at howstreet.com. Company Showcase is a production of Howe Street Media Incorporated.